everybody. Welcome to podcast number 6 of This Week in Innovation. I'm your host, Jeff Roster, former Gartner and IHL retail sector analyst, now serving on several advisory boards. This episode is a recording from a recent clubhouse room that Brian and I did, focusing on corporate investments and M&A for startups. And we are very pleased to have Yvanna Perez Morel, head of corporate development, M&A, investments and strategic partnerships for Ulta Beauty, as our guest. She provides some amazing insights on how founders should work with retailers and brands, and I highly encourage everyone to pay very close attention to the tips she's giving. Very, very important stuff. Now, let's give it a listen. Good afternoon, everybody. Welcome to the Ask an Analyst Clubhouse room. Today we're going to be talking about corporate investments and M&A for startups. I'm here with my co-host, Brian, and he will introduce our guest, and we'll get started here.
Thank you, Jeff. Perfect. And we are super excited to have today's discussion on investment, M&A, and what startups and startup founders should know, as well as other corporates should know about this area. And we are privileged to have Yvanna Perez with us. Yvanna is a part of the Ulta strategy team. She heads Ulta strategy and M&A team, as well as investment strategic partnerships. Welcome, Yvanna.
Thank you, Brian and Jeff, for inviting me today. Super excited to be here.
Awesome, Yvanna. So maybe what we do is we'll quickly get started, and maybe what we could do is it would be helpful if you can give us a little bit of your background and how you got into strategy and M&A and your current role and what you do for Ulta, especially from a founder's perspective, because some of our listeners are founders.
Perfect. Happy to. So starting from the beginning, born and raised in Latin America, so Dominican by nationality. For education, UChicago Booth and LBS MBA, both fantastic experiences. Professionally spent over 10 years in investment banking, focused on consumer and retail companies, both in my home country and in New York. I had some fee experience and some experience in the funds of funds as well across the globe. That was before I decided to switch what they call to the other side, to the corporate world. Yeah, so that's where I actually focused on beauty. So I started my corporate career at Estee Lauder, also in a finance and strategy position, and ultimately Ulta Beauty. So Ulta Beauty, for those of you who don't know, the largest beauty retailer in the U.S. with over 1,200 stores across the map and strong e-commerce business. At Ulta Beauty, I lead corporate development. So as Brian touched on, everything from partnerships, investments, acquisitions, and anything in between. In my role, I constantly interact with startups, whether it's brands or what we are now calling technology-powered beauty companies. So definitely happy to cover and touch on how we interact with startups on a day-to-day. I also try to stay close to the startup community, mostly in my current experience to the Chicago Booth Angels Group. So I'm an active member of that community as well. So happy to touch on any of those throughout the conversation.
Perfect, Yvanna. That is awesome. And in fact, this is all the advice that you're going to give our founders is going to be tremendously valuable. And also you're very active in the industry as well. So definitely love to pick your brain and understand more about all these things. So one of the things maybe we could get started to understand is, as you're looking at companies, right? How do startups typically approach your teams or your peer teams? And when does this conversation start, right? What is the process? If you can help us unpack this a little bit, it will be super awesome.
Yeah, happy to. I would say in terms of how they approach us, it really depends. Sometimes they come to us, sometimes we come to them. But I would say taking a step back before we even begin the conversation, from internally, just what happens a little bit behind the scenes, is that there's a significant amount of work that goes into thinking about the enterprise strategy and how certain investments or acquisitions in specific areas can accelerate that strategy. So a lot of our work is really defining those areas and understanding which companies can really support that. Not to say that there aren't some opportunistic investments, they totally exist, but there is typically a specific goal when it comes to strategic investing in companies. So once we are in contact with the startup, regardless of whether they reached out to us or we reached out to them. I generally organize the process that we go through in 3 phases. There's typically a pre-LOI phase or a pre-term sheet. There's a LOI or term sheet phase. And then there is like the final stage, which is more about like the contract, hiring out the details for the contract and the closing. So if you double click into those 3 stages, I would say in the pre-LOI phase, a lot of the focus is there's an initial discussion, an initial conversation. At some point, we want to learn a bit more. So we say, hey, let's sign what we call an NDA, so a non-disclosure agreement. Really simple document. It's just I won't tell the details of your company and you won't tell why Ulta Beauty or another corporation is looking at your company. And then there is some sort of initial, what we call initial due diligence. So high-level information, whether it's financial or just details about what the company does. Then, assuming that everything looks good on that high-level evaluation, we go into that second stage, which is a little bit more detailed. A lot of the focus there is ironing out a term sheet. And a term sheet, again, it's like the second legal document that you'll encounter after the NDA that we just touched on. So it will cover some high-level terms in terms of structure, valuation, and key investor rights. So what I mean by key investor rights is like, do we want a board seat? Are there any warrants for future investments and things like that? And assuming that we're aligned on that, then we go into a more detailed due diligence process. So wanting to really double click and understand exactly how things work in your company before we make the final commitment. This contract is typically non-binding. At the very last stage, so if you're talking about contract and closing, it's really about what are the details of that partnership. How are we going to manage the next round? How are we going to manage an exit? And all of that, like double clicking, I would say. And finally, the easier piece, which is then the announcement and the closing. Particularly when it comes to tech, maybe taking a step back, there is something that it's not in a traditional process, but happens a lot. And it's that many corporations often want to test the solutions that they're investing in. And they want to do something like a proof of concept as part of the due diligence process. I've heard it from, like, I know that we've done it for some companies, and also I've heard it from a lot of my peers in other companies that when it comes to tech, they typically do want that next level of detail.
Perfect, Yvanna. So that is super, super helpful. And I love the way that you broke down step by step. And I'm sure a lot of founders would appreciate that level of detail. But at the very beginning, when you started, you talked about taking and looking at the grand strategy, right? Listeners' interest, typically a lot of the companies, the corporates who are in M&A or even investments, they have a theme or a high-level strategy in terms of either filling in or fitting gaps that are missing within their organizations, or looking at where the puck is going. Just fun's sake, if you look at Google is essentially their strategy is all about moonshot, right? Basically, how do we actually look at moonshot opportunities, or even looking at test fast and fail fast strategy, right? Facebook is very much the shepherd's flock. If users are getting out of our flock, if they're going to Instagram or they're going somewhere else, TikTok, let's go buy TikTok, right? And then eventually all our flock will increase along with the new flock, right? So in that scenario, like, what are some of the interesting strategies that you have seen, and where do you place yourself in terms of looking at those things?
Yeah, I would say that some of the ones that I've seen the most, I would say are, let me call out 3 that comes to mind. I would say one is looking at building key capabilities for the company. So a lot of the times, and to your point, Brian, a lot of this just gets to the difference between a strategic and a financial investor, right? Because a strategic
Correct.
typically has a larger goal in mind. So back to some of the things that I've seen is one, building key capabilities. So if you think about startups and them being able to provide or complete, so to speak, some roadmap. So one example of that is when Ulta Beauty, a couple of years back, acquired 2 companies, Glamstreet and QM, in the AR and AI space. In that case, it totally made sense for us to have that capability in-house, fully own and control that capability. And that's why we decided to ultimately acquire those companies, because those were going to open the door, given Ulta Beauty is basically it's focused on makeup, and we wanted to make sure we had this life makeup try-on experience and we could provide targeted recommendations to our guests at that moment. So that's, I would say, one example. Another example is when companies want to do co-development or they want to co-create. Like the startup has a starting point and they want to build on that. So that's another case where there's a lot of focus on maybe having a little bit more control or having a little bit more ownership on the company because a lot of the value is hopefully being created together. The last one that I've seen a lot is like placing small bets. So a lot of the companies have what we call CVCs, so corporate venture capital arms. And those are really focused on if there's a new technology, it's really unproven, for example, they may choose to invest in, I don't know, maybe like 3-4 companies in the same area, sometimes a lot more. So like a couple of companies in the same area to see which technology develops or if technologies are slightly different. So that's another one. So if I were to summarize, key capabilities, co-development opportunities, and placing small bets where I see a lot of the focus.
Fantastic, Yvanna. I think that is definitely very exciting, given the fact that startups are very interested in working with larger corporates and also getting their technologies adapted. Do you also, as a part of these key capability investments, do you also see that these companies get some form of rollout within the organization as well? Is that a part of that one, or is it just very much a bet and see which surfaces to the top and then pick up, then look at commercial discussions or further discussions with them?
You mean in terms of doing both commercial deals at the same time as investments, or how are you thinking about that?
Yeah. Primarily, my question is very much in commercial. How do we blend commercial relationships with investment type opportunities? Because I remember in my past life when I was in corporate investments, one of the challenges we had was that we would invest in the companies, but it would take forever to commercialize them within the different, because there are a lot of different business units and the various GMs have to sort of buy into it. So how does that all, cohesively work together currently?
Yeah, I would say it depends on the capability itself. It also depends on like how large or like the stage of the company. I would also say it depends on the goal that the corporation has. A couple of examples that come to mind. If we were to invest on a brand, a lot of our competitors do actively invest on brands. If you are a beauty brand, again, I'm giving an example in beauty, which I'm closest to. If you're a beauty brand and you buy that beauty brand, you're probably showcasing it in your box almost right away. So that's going to be like front and center. You get those pre-approvals almost right away. That was also the example when we did publicly at this moment, the partnership with Target. It was pretty much front and center public knowledge. Everybody knows about it. But then when you pivot a little bit and you're talking about more technology and capabilities, that's really where there's a lot more nuanced approach. For example, in the case of that company that I was telling you earlier, and I know that you're somewhat close to that company as well, like Glam Street, with the live makeup try-on experience, even though it is a technology play, it is pretty much front and center. It's in our website, it is in our app. We continue to talk about it in earnings calls. It's everywhere. But at the same token, there are other companies that we invest in that are not necessarily known, and nobody knows that we've invested in them. And I do believe that's probably where the majority of the companies fall for the majority of the corporations that are actively investing.
No, that's a wonderful point, Yvanna, because I think you're right, because a lot of times some investments and some M&As are very key capability towards key capabilities. And then the others are more adding technology or even like taking bets on what's going on. So that's definitely very insightful and very helpful. I'm sure a lot of founders and other type of startup teams would really, I'm sure that was very helpful to some of the startup people to hear. Now, the other thing I wanted to also understand from you is when startup founders are approaching either your M&A teams directly or even any of the business teams, what are some of the best practices and what should they be mindful of? What is the right thing to do and what are sort of the wrong thing to do? What would be your advice?
Such an amazing question, Brian, and I'm sure you'll have a perspective on this as well. But I would say it comes down to being prepared. It may sound really simple, and yes, I'm sure your product or your service, but communicating its value can really take a startup a long way. 3 recommendations that come to mind. 1, clearly articulate what your product or service does and why you have a unique solution versus other companies, and make it simple. Like, if you're talking to the corporate development person, that person may not be, for example, a technology expert. We try to bring our partners to the table the majority of the time. But if it doesn't happen, we still want to know why your startup is special, and we still want to understand it. Second, share why you think your product or service would be great for me, company X, versus someone else. It's really important that I understand, like, I've had some cases where I see it on the retailer side, and I've had some cases where I see a whole presentation and it's all about why they're great for brands. And I'm like, can you please, I don't know if this has happened to you, Brian, but I was like,
totally.
And it's like, can you please just like tell me why this is great for retailers, or an example when you've worked with retailers? And last, but definitely not least, don't be shy about saying exactly what you want. I don't want to leave the room not knowing whether you are looking for one business, so like a normal contract, or whether you're raising a seed round and how large your round is. I just really want to know, what are you looking for in that conversation?
That is definitely super helpful, Yvanna, because I think that the latter one is somewhat of a problem, right? For most founders, they beat around the bush. Some of them are straight shooters. They'll have their pitch. But especially for corp dev and strategy teams, it's better to communicate it clearly what your intent is, because you can also communicate that along with your business colleagues and your business teams as well. I think that's definitely, I think it's a very important point, and I think founders should take a note of that.
Oh, Brian, it's interesting.
Yeah, 100%.
Oh, sorry, Yvanna.
Go ahead.
You know, it's interesting the point you said about the simple piece of making sure your PowerPoint is appropriate to retail. Up until really my last day as a working analyst, I would still see startups pitch me about something in retail, and instead of just changing the PowerPoint to say store, they would say central office or something horizontal. And I mean, from the first day, I saw that. And really important for founders, if you're going to try to pitch a vertical solution, make sure the vertical language. I am literally talking about editing a PowerPoint. And Yvanna, I'm curious if you've had a situation where startups would come and pitch to you and they haven't been to your store yet.
Oh, yes, all the time.
Okay.
And they would, or they would ask, "Oh, can you tell me a bit more about Ulta?" And look, I'm happy to talk about Ulta, but if you have 30 minutes with us, I would love to talk about your startup. And if we can do a little bit of research on both sides, I typically do a bit of research on the startup before. Like that just makes everything a lot more efficient, and you can take a little bit more time on answering my questions and making sure that I can sell your idea correctly internally.
Yeah, for founders, if you do not go visit a retailer store before you go talk to a retail executive, honestly, you shouldn't have the deal. You should not have if you're that lazy. And I'll be that blunt. And you don't have to be that blunt. I will be. You have to. Typically, what most of the retail executives I've talked to over the last 20 years, that's the first question I'll ask. So tell me about my stores and what would you do differently, or what are some of the problems in my stores? And what happens way too often is you get well, I really haven't been there. Or I might have stepped in, but I didn't go and actually think about the business of the store. And boy, that's a deal killer. So you've got to put your time in. You're spending a fortune to get that meeting, and you're not doing the simplest thing, and you're going to lose that deal. So interesting, that's still an issue.
And Jeff, I know what question is brewing in your mind next. All these M&A and investments are going on. How many companies are getting acquired? And how is that in relation to retail? Where does retail stand in terms of investments and M&A compared to other industries?
That is exactly the question. That is exactly how big is the market? What is the opportunity? Is this a potential threat to the incumbent software providers, which it certainly is? And how does this drive innovation? Yeah, Brian, I'd love to. I bet you have some thoughts on that. I'd love to hear what the numbers are.
Yeah, I have some numbers, and then we'll go to Yvanna with some more questions. But let me give you some high level numbers and kind of paint a picture, right? In 2019, right, there was about 8,000 400 plus startups that got acquired. And out of that, 699 was companies that had commerce, retail, e-commerce, or some sort of a restaurant or convenience store or delivery type of capability. So that's 2019. Then go to 2020, during the pandemic, there were 7,932. That is 7,932 companies that got acquired. 466 of them was retail. What does that number compare? What does that number compare in relation to how many companies that IPO? So in 2020, 690 companies IPO, but 7,932 companies got acquired, right? So that is, of course, a 10x, 12x. So that's natural, right? So there's always more companies that got acquired because acquisition is a very common way companies exit, right? So retail is actually not bad. You're looking at about 5% of total acquisition happening in the retail space. So that's pretty good.
So Brian, those are technology companies, though. Those are not brands. Those are not retail startups. No, those are tech companies that have IPO'd or been acquired.
They are tech. The ones that got acquired are tech as well as DTC brands and even like company like Drizzly, right? Drizzly got acquired by Uber, but Drizzly is in the delivery space for alcohol, right? Same thing like Deliv, right, which got acquired by Target.
Okay, so services.
So those all in that space.
So tech companies or services. Well okay, interesting.
Yeah, or enabling technologies, or even some level of DTCs, some direct-to-consumer companies are included in that as well. But not major brand acquisitions. That number is not there. Yeah. One other thing, Jeff, I think I was also interesting is in the last 2 years, I've been looking through Crunchbase and our own platform Signals, and then as well as some of PitchBook data. In both in retail as well as in the general industry, you suddenly have a whole lot of new players who have become acquirers, right? That means a lot of traditional companies who have started buying technology and small companies just to get the right key capability. And the companies who are like very acquisition intensive, right? Google, Apple, Microsoft, they have not acquired a lot in the last couple of years. So till date, in 2020, Google just did 2 deals. In 2021. In 2020, Google did 4 deals. And in 2019, they did 5 deals. Compared to 2015, I think they did 12 or 13 deals. So that number has reduced. So these single intensive players have slowed down, but at the same time, more players are coming into the market. So it's increasing the exposure coefficient, right? So there's been more players who are buying, but the intensive players who are acquisition intensive are not as buying as much.
Brian, I'm really curious when you are, because this is your space, when you're working with retailers, tier 1 retailers that are working with you or some of your competitors around with startups, how would you classify them from a technology adoption perspective? Aggressive adopter, mainline, conservative? Now, I'm sure Alto's going to tell me that they're a mainline adopter, which is crazy. You're, by any definition, I would think you're an extremely nimble, very smart retailer from a tech perspective. And I consider you probably one of the top 4 or 5. But Brian, what do you think? Are these typically aggressive adopters, or was it all over the map?
See, I think it's all over the map. And also, Yvanna touched on, it all depends on what the priority at any given point any retailer is in, right? Like what Yvanna said, a few years back, Ulta acquired 2 companies. They're excellent companies. And similarly, a lot of retailers acquire if there is a need basis to bring in key technology capabilities and not. But in general, I think if you just look at the overall acquisition space or even corporate investment space, the larger technology companies, the Ubers of the world, the Googles, Apple, Amazon, Googles of the world are leaders in terms of buying and adding more and more new technology capabilities, right? Retailers are far behind in that equation. But some of them, like Target, Ulta, and a few others, are pretty good. I think I would say they've done a fantastic job. Also, Yvanna, if you have comments in this space, love to hear your thoughts.
Look, maybe not directly to the space, but I would definitely say that we have seen an increase in, I would say, valuation and deal activity just recently, right? Just because of how a lot of things seem paused on 2020 20, but it has not been proportional. So it has not been across the board within retail. So even within a specific vertical, I would say you have double clicks. So for example, in retail, which is where I'm most familiar with, a lot of the activity and a lot of the increased valuation was really happening around home, around pet, around sporting goods. It's like this categories where people were really focusing their time and their effort. Whereas like some of the other categories like department stores and like things like that were less, at least it got less love, so to speak.
Interesting. Did we unpack a little bit about the mistakes maybe that founders are making when they approach you, Yvanna? I certainly not knowing your business is probably the biggest mistake you can make. But what are some of the other mistakes you've seen as founders would approach you? Is there a pattern?
Yeah, I would say definitely in addition to being prepared, which I think that by far is the biggest mistake that I've seen throughout, there are some thoughts of things and practices that I think could be very beneficial for them. Think about relationship building. Think about relationship keeping with that corporation. So sometimes it's as easy as adding me to your newsletter, send me some articles of the things you've been up to. I do want to know about the things you've been up to, and maybe something that wasn't relevant the first time that we met, 6 months down the line, and maybe with some tweaks that you've done to your company, now they're exactly what I'm looking for. So definitely that's a big plus, I would say. Another mistake, or on the flip side of that, is what I would call burning bridges. So I've had a couple of cases, it doesn't happen every day, but like I've had a couple of cases that I know some of my colleagues have as well, where maybe someone doesn't reply to your email and then you start sending emails like, oh my God, I thought you guys cared about such and such development. And it may really not be that we don't care about that area. It may be that it may be happening for 1,000 reasons, but you as a company, as a startup, don't burn any bridges. Like just keep it positive. Let me know the changes that you're doing on your side. And more often than not, you'll see that people will want to learn about those. Have you guys had that experience, Brian?
Absolutely, Yvanna. I've had that. It's funny because I think the first startup that I did, in my video streaming startup in 2007, because in 2007 we raised quite a bit of money, but in 2008 the market hit, and then the whole real estate meltdown happened, and then it was really hard to raise money. So few corporates that I built relationships. In fact, I went asking them for investments, right? Because traditional VCs stopped investing. But over time, I began to build relationships with some of them, and even till this day, right, I have great relationships with them because even though in certain cases some of them did not invest, I kept on, sending them stuff. I love the concept that you were talking about. Send them newsletters, send them like a quick note, right? Hey, how are you? Here are some cool things we did. Just want to let you know, and keep that bridge going and the conversation going. Because sometimes, this, like you said, the world is ever changing, both from the corporate side as well as from the startup side. Something that you may think as a startup that may not be relevant to this company at this given time, but maybe completely relevant because their business suddenly changed, or sudden area, one of the key areas was not a key area prior,
Totally.
Suddenly became a key area.
Absolutely. And don't follow up every 2 days, but definitely every few weeks, every few months. Absolutely. I want to hear from it. And maybe down the line, there is an opportunity for us to collaborate.
Absolutely, Yvanna. And one more quick thing I would like to add there, right? For founders, when you follow up, don't follow up asking for meetings, because startups, like a lot of the corporate leaders, are very busy. But send them a quick blurb on what you're up to and what's going on. Cool. Even industry trends would actually help these leaders, because a lot of these leaders don't have time to read everything, and you want to help them with the right information to help you, right? That's kind of an interesting thing I've learned as well.
So kind of a selfish question.
I couldn't agree more. And maybe I'm in a meeting and then I'm like, oh, actually, I saw this, and this startup was just presenting this result. And that's where your name gets tossed around the table, just because I remembered it was in an email. I pull it up in the middle of a meeting, and all of a sudden, boom, the name of your startup came up.
One question I have for you is in terms of a lot of, typically I was originally not going to ask this question, but then I looked at your background and you've been a Merrill Lynch investment banker before. So I thought it was interesting to ask this question. Traditional M&A teams and investment teams, they have deep relationships built with investment bankers as well as founders, as well as the whole ecosystem and community. But if you look at a lot of the tech Silicon Valley M&A teams, they shy away from bankers because they feel like bankers sort of jack up the price and they, being a middleman, and they create more, sort of, it become the intermediary, right? So what is your general sense of working with bankers?
It's a great question, Brian. I would say that it's about leveraging them correctly. Having been on the other side of the table on the investment banking side, I do know certain parameters. For example, investment bankers like a Goldman, for example, or a Merrill Lynch would be less relevant for a $10 million deal for a small startup, right? Like they wouldn't even engage in some of these discussions. So I would say we leverage bankers and we leverage a relationship with our bankers. I continue to I value deeply my relationship with them, but it's more about understanding what's happening, what are some of the high level trends, getting a pulse on some of the subsectors, and maybe supporting with some of the bigger deals and transactions. Now, for everything else, it happens a little bit differently. It happens more through VCs, entrepreneurs, like it happens with a lot of different players, and quite frankly, a lot of connections, and a lot of it comes from whether it's a top-down exercise, like these are the buckets where we want to focus the strategy. Let's go look for startups, or even bottoms up. So if we get an inbound and we're like, hey, that's actually perfect for this that we wanted to go do. So I would say the majority of it falls on that latter camp, at least for us. But I think it's true for the majority of the of my corporate peers, and less so on the investment banking side, unless you're talking about a large deal.
Perfect, Yvanna. No, that definitely makes sense, and hopefully our founders, it helps them as well to understand how they should approach corporates such as Alta and others. One question I have is that where do you see this whole corporate investment as well as M&A trend going in the next 2 years, both from your personal perspective as well as Alta and also the beauty industry in general?
Perfect. I'll cover the retail space and beauty, and maybe less so on the Ulta specific side. But I would say that focus on the M&A and investments, I see them as being very strong for the foreseeable future in both retail and beauty. We're coming out of 2020, as I was touching on before, where the deal activity practically came to a stop in Q2, then picked up in like Q3, and then after Q4 and early 2021 really became strong. Some of these deals were already in process before the crisis. One notable deal in the space was the LVMH Tiffany's deal, but that's a huge deal. But just as that one, there were a lot of cases of deals that were just in process. And I was talking to VCs all the time, and they were telling me, oh, yeah, we had all these deals and we couldn't. And then they started again later in the year. Another example is more on the response to a new reality. Like the world was changing very rapidly. And for example, some companies use that to acquire new capabilities, or they needed cash. For example, another notable deal in the space, Ralph Lauren divested Club Monaco to a private equity fund. And that was just in looking for focus and looking for cash. The last bucket, I would say, is more an opportunistic transaction. So there was a lot of, okay, this company's not doing that. I need that capability. I have the cash. I'll go ahead and get it. So I would say across the board, this is where we're coming from. And if I think about going forward, which is really getting to the heart of your question, I believe that right now most retailers are focused on defining what they would call the next normal. So they're taking a step back and they're saying, okay, coming out of the crisis, what will be my competitive advantage and where exactly do we want to play in? And for some of those, so for those who are in a better cash position, the answer will be looking into industry consolidation, acquiring smaller players, or looking at complementary capabilities, particularly in areas like digital. So that's where I think a lot of the startups have a lot of opportunities. But all in, I do expect that the M&A market will remain strong. And quite frankly, I didn't go into a lot of detail there, but also valuations will remain strong in retail. This may be a little bit different for other sectors, at least for some time.
Absolutely, Yvanna. I had the same thoughts as well. You're spot on. I think we are expecting a lot of growth, especially in the next couple of years to come. And also, given the fact a lot of these techs are also all looking for acquirers, so I think there's a lot of acquisition activity that's going to definitely go on. Yeah, it's going to be an exciting market. We are looking for an exciting time. Jeff, do you have any questions?
Just to recap, it was just very interesting to both of you. Picked up on the concept of relationship. I used to get asked all the time, how often should I communicate with you as an analyst to the vendor community? And I had a stock answer. It's as often as you need to. And I was hoping it wasn't every week that they wanted to do that. But for the most part, my experience was most companies probably did not communicate enough with their analysts. And it's really interesting to hear you both say maybe bi-monthly or quarterly. I think that just seems to be a good pace for anything. And my guess is most of the founders here probably aren't doing that. And to a certain degree, shame on them, because it's certainly how you want to communicate with the analyst. And it sounds like that's how you want to communicate with the VC, as well as retailers that have clearly expressed interest in working inside the startup community. That was very interesting. That's a common theme: relationship. Build relationships. Do not do drive-bys. You will get nothing if you're doing a drive-by, but build a relationship. That's assuming you want to be around for a while. So that's a real big takeaway for me. For both of you, where do you... Obviously, I think we're all bullish on retail. The numbers are just off the charts for sales growth. Do you see that going into 2022? Obviously, we've had a crazy year, but sure looks like all the indicators are in the right direction.
Yeah, I do see it going into, for retail in particular, I do see it going into 2022, but not across the board. That's where it really goes back to differentiating the subspaces. There are cases where, for example, sporting goods, home, pet, they really had a moment. And there's some of these things that this is not the space where I spend the most of my time. But I would think that, for example, something like home, where a lot of people were focused on doing some of the remodels, may not fully, like, people will do one remodel and then they may not need to do it next year. So that may slow down a little bit the pace of the remodels going into 2022. I still think they're still strong, but that may be take a different pace. Whereas some of the sectors that were a lot more hard hit because people needed to go into the stores, they may actually just pick up a little bit more just relative to 2020, 2021, just because people are feeling more confident and are vaccinated now and are thinking, okay, now we can.
I have the same viewpoint as well, Jeff. I think a lot of the stimulus that has gone in, and as well as some of the people who are vaccinated. Most of the population today is vaccinated, and as they are going out during the summer, you will see increased activity, and that will continue over the holidays and the Christmas season, and then it will continue to propagate next year as well. And I love the point what Yvanna was saying. There's a lot of subsectors. I think the trick here is to figure out what those subsectors are. If you listen closely to the market, you can figure what those are and respond to them. And one final thing, Yvanna, before we close out, I don't know whether we're going to have questions. Are we going to have a question session today for the audience, Jeff, or are we going to close out?
I think it depends on you two if you have time. Yvanna, you've been just crazy generous with your time. Do you want to take a few questions, or do you need to wrap at the top of the hour?
I can take a few questions.
Oh, fantastic. If any of the founders or anybody in the audience has a question, just raise your hand and we'll bring you up to the stage and probably go 2 or 3 questions and we'll go from there. Interesting. So I would agree with both your observations. I just think we're teed up for an amazing 2 years in retail. Half of retail just was devastated in the last year. And the other half, the essential retail, is hit a very solid time. So I think all in all, we're going to see quite a run for the next 18 months.
I think Manny had a question.
He did. He's up. Manny, how are you doing? What's your question?
Beauty is a very intensely personal business where the customer has to be in front of the beauty consultant and in front of the beauty product. Last year, the store closures impacted that greatly. To what extent do you think technology has helped to fill the gap, and going forward, what's the picture?
I think that's a great question. Thank you, Manny. I would say I cannot say enough how much that technology helps fill the gap for beauty. For example, coming out of in 2018, back to the acquisitions that we were mentioning before, for example, the makeup try-on experience that we have. We did these acquisitions in 2018. We thought they were important at the time, key actually, but we never imagined how important they would become in a situation like COVID-19. Nobody was expecting this, but all of a sudden, it became a good platform for our guests to just be able to experiment and to spend a little bit of time and to try certain colors. And we saw tremendous results in terms of like increased conversion, increased engagement from our guests, and it really made a difference. And it's something that a few years back, we wouldn't have foreseen to the extent that they really helped fill that gap. Going forward, I think that people will be able to go back to the stores. Yes, that's true. But at the same time, or they're already going back to the stores, I would say. But at the same time, I don't see that necessarily going away. I do think that it's going to be complementary, and it's just going to be one more touch point. A lot of our guests really try it on online, and maybe they walk in and buy that and something else. So it's about creating a true omni-channel experience and complementing the two, the in-store and the technology or the online piece. Great question, Manny. Thank you.
So, Manny, could you ever imagine 20 years ago when we first met at that NRF a long time ago, we'd be talking about how important technology is to retail?
Thank you. Thanks, Jeff.
Any other questions, or should we close it out? Brian, why don't we close it out? Yvanna, thank you so much for spending the time with us. Every time I see Ulta, I just look at an amazing retailer. You were one of the examples when I was doing the battle for the silliness of the retail apocalypse story. I always pointed to Ulta as just literally doing everything right. My daughter's spent a lot of money in your stores over the years, and I feel very good about the process, other than spending all that money. But as far as a quality retailer, one that's just setting the standard, very innovative from a tech perspective, solid customer service. Your executives are always good speakers at every conference I've been to, just for an industry that needs champions, needs executives to really stand up and speak to the value of technology. Let me just say thank you for all of us.
Likewise, I like to echo that as well. You guys have been a wonderful partner as well as a wonderful company as well. You guys are setting the standard for retail and a good leader to follow.
On behalf of my team, I'm pretty sure they would echo this. Really appreciate your words, both of you, Jeff and Brian. And thank you very much for having me today.
Thanks for tuning into today's episode. For more info, refer to the pod notes below. If you enjoyed this episode, please consider giving us a 5-star rating and review. It really helps us grow. I'm your host, Jeff Roster, analyst at large. If you want to connect, follow us on Twitter at JeffPR or at BrianSathanation, or connect with us on LinkedIn. Visit my website at roster.retail.com or Brian's at iterate.ai. Until next time, stay safe and have a great week.